for future. And in addition, the opinions expressed herein are those of the presenters themselves. It is solely meant to be for educational purposes and for information. So with that said, we have a full deck, so we want to jump right in. Great. So our overview for this session is primarily broken down into three pieces. We will discuss or start with elements of IFRS 17 that necessitated the need for change in KPIs. KPIs were very important to the structure in which we operated our businesses, and as such, a new accounting standard ripped the rug from under us, so to speak. Then following that, we will discuss a few KPIs that we have seen and both use internally, and that will provide you with the ability to map for where you were monitoring your businesses before, and these will allow you to use elements of IFRS 17. And then finally, we'll go into the fun stuff. We'll actually see an illustration of the use of these KPIs and do some stress scenarios to see what the KPIs would indicate coming out of the described stresses. So without further ado, I'll hand over to Kezia. Oh, actually, no. The next slide, please. Right. So what elements on the IFRS 17 would have changed? Well, the key one that everyone likes to talk about is the CSM. That's a contractual service margin and the loss component. So these two are the introduction on the IFRS 17 that impacted the pattern in which profit was recognized. They're extremely important in being able to monitor, as Kezia will go through, some of the growth strategies. Premiums. The old star of the show on the IFRS 4, a lot of businesses linked almost all their KPIs and all their projections on premiums. Now, guess what? It has been ripped from you because premiums no longer appear on your P&L. So your KPIs now have to juxtapose or be repositioned to allow for what IFRS 17 would allow you to in the absence of premiums. Grouping of contracts. This is a new idea proposed on the IFRS 17, wherein insurance contracts that exhibit similar risk and are managed together are grouped. What this means is the treatment of being able to aggregate, you lose that benefit in that respect. And then finally, for the major items that I want to discuss here, is discount rates. In the past, we would set discount rates based on our asset portfolios, which was very specific or intrinsic to the companies we worked with. However, under IFRS 17, discount rates are determined by the market and the characteristics of the liability for which they are intended. All right, so now I'm going to turn over to Kezia, and she's going to walk us through the KPIs.
Thank you, Mark. Right, so let's have a look at the KPIs we plan to introduce. They are listed in this table here, rightmost column. Has a list of our IFRS 17 KPIs. We'll introduce them and discuss them in detail. What we've sought to do in this table is also add some traditional KPIs that were in use pre-IFRS 17. And in a lot of cases are very similar to the IFRS 17 KPIs that we will be discussing. Not necessarily identical, not necessarily predecessors, but similar in concept, similar in calculation. Right? You would observe that our IFRS 17 KPIs, they are grouped, 4 groups, growth, profitability KPIs, capital KPIs, and other miscellaneous KPIs, which we will go through at the end. So let's start with the first group, our growth KPIs. CSM. We've all heard of CSM, Mark would have mentioned it. CSM is your unamortized profit that you will recognize over the life of your products, right? This CSM metric is commonly used in growth performance indicators and new business tracking. Now, if we think back to pre-IFRS 17, CSM is actually akin to another metric we used to use, and that's the value in force. Our embedded value calculation used value in force as an input. And value in force, the definition is present value of profits expected from our existing block of business, not that dissimilar in terms of terminology, right? So just a point to note that the CSM metric is similar to something we would have used before. Obviously, pre-IFRS 17, we didn't calculate VIF, sorry, with our liabilities. Presentation and calculation was different, but principle was similar. So in terms of the metrics now, change in CSM, which is CSM at the end of the year, simply minus CSM at the start of the year, is a popular growth KPI, right? It is a simple calculation, but it is commonly being used in practice as a growth KPI. Secondly, we have new business CSM. So this is your CSM from contracts initially recognized during the period. Another KPI. We can take that KPI further into the third KPI, value of new business. So if you take your new business CSM, you add your initial loss component, you add your new business risk adjustment, you get what is termed the value of new business, all right? And the fourth growth KPI is termed the CSM Sustainability Index. And this is your initial CSM or your new business CSM over your CSM released, right? New business CSM represents CSM added from new products. CSM released is CSM that is amortized into our P&L. So it's CSM that leaves our CSM balance. So we have CSM added over CSM released. A sustainability index of greater than 1 states that we are adding more CSM than we are removing. And it suggests that, as the name suggests, sustainability index, the CSM will be sustained, over the future, right? Conversely, a CSM of less than 1 would suggest some sort of runoff pattern in your CSM. But again, CSM, as simple as it sounds, is very important for the growth KPIs, and number 1 change in CSM is very popularly used as the growth KPI, the main growth KPI. Next, let's look at our profitability KPIs. Return on equity. That term, should resonate with all of us. Return on equity, right? Pre-IFRS 17, return on equity was a major profitability KPI for products as well as companies as a whole. Under IFRS 17, that hasn't changed. We continue to use return on equity. Likewise, the calculation for ROE, it hasn't changed under IFRS 17, or it need not necessarily change under IFRS 17. So the equation for the formula for ROE is profit over equity, or profit over average equity over the period. That formula can still be used under IFRS 17. The formula can be slightly modified to add elements like CSM to the denominator for a more comprehensive view of equity. Another variation allows for the addition of your risk adjustment to the denominator for a more comprehensive view of equity. But fundamentally, the formula remains, largely unchanged. There isn't much computational complexity added to the formula. Of course, ROE pre-IFRS 17 and post-IFRS 17 would differ because your individual components, the amounts would differ because of the IFRS 17 calculation, but the formula itself is largely unchanged.
So Kezia, question for you. Tell me, what is this? What's the benefit of RA? And maybe I should ask you to tell me what this RA is. What's the benefit of including RA in my computation of the ROE?
Sure. Your RA, risk adjustment, is your embedded risk premium, right, in your net liabilities. Pre-IFRS 17, it was implicit in our reserves. Now, under IFRS 17, it is explicit and is explicitly amortized in a profit in our P&L, just like CSM, explicitly amortized. So the rationale for adding it back to equity and in the denominator is that it gives a more comprehensive view of equity, as both will be added back to equity, added back to profit, added back to equity over time. Right, so we've discussed ROE, major profitability KPI. I'd like to add 2 more KPIs to profitability, but I'd like for us to do it together. All right, so we have 2 KPIs on the on the left, the extreme left, traditional KPIs, not IFRS 17. We've listed our combined ratio, simple ratio, claims and expenses over premiums. You may have heard of combined ratio, you may have heard of loss ratio, which is similar, just claims over premiums. But here we have listed combined ratio, claims and expenses over premiums. What we have to the right is a sample P&L, sample IFRS 17 P&L, with all the line items you would expect. Now, if I want to derive an IFRS 17 KPI, which is similar to my combined ratio, my combined traditional KPI ratio, can you suggest a formula that I could use that would achieve the same purpose just by looking at the line items? So that's one. I'm actually not trying to trick you. It's actually a very simple, easy answer. Similarly, underwriting profit margin. Underwriting profit margin is your underwriting profit over your premiums, right? And underwriting profit is profit we generate from underwriting activity. It excludes investment income, investment earnings. Again, based on the information we have in our IFRS 17 P&L, can we find a partner IFRS 17 KPI that is similar to this underwriting profit margin? Mark, do you have any suggestions?
Yeah, well, maybe I can give a hint. So if I'm looking at the formula for combined ratio, and traditionally where this was used in the past, you would probably want to be looking at outflows versus inflows, perhaps. And the underwriting profit margin seems to be, where you find revenue again based on your inflows. Is there a similar mapping?
Yeah, I think so, and I'm sure those in the audience have identified. Sure, go ahead. This is what we would suggest. I'm sure there are no wrong answers, but this is what we would suggest, right? Under IFRS 17, we have what's called an insurance service ratio, which is equal to your insurance service expense. So you'd see that line item, 2670 over your insurance service revenue, right? At the top, 9200. Now, as we said at the start of the presentation, premiums no longer exist in our IFRS 17 P&L. So insurance service revenue is what we would use in our KPI, including these two, in place of premiums, right? Underwriting profit, we chose insurance service result. And again, premiums, we choose insurance service revenue. Now, the P&L presentation of IFRS 17 actually makes the calculation of this metric much easier because profit is split between our insurance service result and our net financial result, right? So it's easy. We can just pick the insurance service result here, tag it to our numerator. It's our proxy for underwriting profit. And there we have a new profitability KPI. Okay. Moving on to our capital KPIs. Now we have to mention here, capital ratio. So the capital regime in the Caribbean is not consistent. It's not consistent across territories. We have a capital requirement in Jamaica, like at calculation. In Trinidad, it's factor-based, deterministic, right? In other territories, it may be a flat requirement. So in terms of comparability across countries, it's not easy. It might actually be impossible. However, the capital ratio calculated is still a major, if not the most major capital KPI. The other capital KPI we have listed here is comprehensive equity. Comprehensive equity simply is an equation which seeks to augment your equity. So as we mentioned before, you can augment your equity by adding your CSM. And well, what we did not state is that CSM does not contain profits from contracts valued under the PA. So in order to overcome that shortcoming, you can actually add in addition to your CSM, the present value of future profits under the PA. Other KPIs, simple KPIs that companies can use and track listed here. So your CSM to total liabilities, your risk adjustment to total liabilities, your loss component to total liabilities. All figures that are easy, to plug in and just track ratios. The usefulness of this ratio would actually be to insurers and perhaps to regulators as well, as it might help them gauge whether their own calibration of the items, so CSM, RE, and loss component, is in line with the rest of the industry, what other insurance companies are doing.
Right, Kezia, I have some questions, if I can interrupt you, that are related to what you're just discussing here. So the first of which is, if we were to consider the combined ratio, traditionally it was used for short-term business primarily. And the question is it now being used for long-term business? Can that be misleading? Or is that giving us an opportunity for long-term business to have a measure similar to combined ratio?
I would think so. I think, as I said, the presentation, and this goes to the other metric as well. You know, in the IFRS 17 P&L, the disaggregation of profit, it's very visible. Which profit is coming from your insurance service result, which one is coming from your finance result. So I think in terms of that, companies would want to track those things separately, right? They would want to track what's being presented here separately. So in as much as combined ratio was historically, you know, for short-term products, I do think it's useful under IFRS 17 in this context because of the presentation. And
Okay.
you know, these components do have a long-term feature as well. Insurance service expense is not a short-term calculation. It is a long-term calculation. So it is appropriate for the in the life context.
Okay, thank you.
Hmm?
Okay, I think
So
that's
I'll
my
hand
cue.
sorry, I'll hand you over to Christy now. So we can see some of these KPIs in practice. Christy will take us through some case studies and add numbers to the principles we just discussed.
Yes, thank you, Kezia. We just had a very good discussion, an introduction into some of the KPIs, just to let you know that there are many, many other KPIs that are in existence that are, I think, developing. It's IFRS 17 is very new, and we are, continually looking at what KPIs we can use to best track our performance. But the reason we focus on just a few is to, one, not overload you, and also because we're going to take you through some stories of potential situations that can occur, and what could you expect from the KPIs? How can you interpret them? What are they exactly telling you under these stories? Right. So for our story, we will have two protagonists. We will have a traditional life insurance company or a savings-oriented life insurance company. And the main difference between them is, of course, just the products that they offer. In the stories that we tell, we will focus on the impact or the KPIs that will come out of either one of them, whether it be a traditional company or a savings-oriented. And I will call out in the scenario which one we're looking at. And then we have our antagonists, our situations that could be adverse, that are potentially opposing forces to our protagonist's goal. They potentially might hurt the business, maybe not, but KPIs are a way for us to see what exactly will happen if these scenarios occur. First scenario is a pandemic, very similar to what we all experienced a few years ago. Second scenario is seemingly very good and very different from a pandemic, where there's an economic boom because we just discovered a brand new, very useful and resourceful mineral in our country, and it's having an impact, of course, on the entire market. And the third scenario is a little less, comprehensive and market driven, and it's more something that would affect an individual company, which is that something happened, there's a scandal, there is something that occurred that has made people lose confidence in a company. And once this happens, of course, you would expect that people would try to get their money out. How does that hurt the business? Or let's say you witness that there is something in the news that might be negative about a company. What can you expect to happen to their KPIs? So without further ado, scene one, the pandemic. pandemic has occurred, and our main character in this scenario will be the traditional life insurance company. So what does our pandemic look like? Well, the situation is that we have very recessionary-like features, such as a decrease in new business, a decrease in economic activity with the lockdowns. People are a little bit strained for money, so they might be lapsing policies. Inflation is increasing. Inflation is increasing because there are supply chains disruptions, and interest rates are low in keeping with the low economic activity that is happening. The other thing that's happening is what you would typically automatically assume happens in a pandemic, which is that your claims are much higher than you would have previously witnessed or expected. So we'll start with the growth KPIs. And the common theme with the growth KPIs is that you're going to see CSM all over the place. Every single one has, well, this one doesn't have it in the name, but it has CSM in it also. Our growth KPIs heavily rely on the CSM metric, and the impact that we're seeing on it is very much what you would expect if you just intuitively from a pandemic situation. Your change in CSM is lower, not that low to go negative, but it is, you are putting on less CSM typically because of your less new business that you have, and also, I guess, what you're losing from the policies that have lapsed. Your sustainability index then dipped under 100%. Then Kezia would have mentioned about that trigger point, that break-even point of 100%, which means that are you putting on more CSM than you are recognizing in your P&L. In this case, in the pandemic scenario, it has dipped under 100%, indicating that we might have some runoff in the CSM, but maybe not a huge issue if it's something that's short term. The good thing about CSM and the IFRS 17 way of doing things is that the policies or the performance that you experienced in the past is going to continue to serve you even in times of crises, because you'll continue to drip a little bit of that past CSM into your income statement. Otherwise, new business contribution, which is just the CSM that you got from your new sales over the CSM that is the total CSM in your company, has dropped also. It's a lower percentage from 13% to 7%. Kind of expected, not much more to say about that. You have lower new business, you would expect that it would be a smaller percentage. And your value of new business, which is very similar to the other metrics, except that it includes, if you have any loss components, also dropped. So growth KPI wise, very easy story. The pandemic has hurt your growth. But what if we switch now and we look at the other two, some profitability KPIs and some capital KPIs? Do we expect to see the same thing? In terms of profitability, yes, right? Your equity, your return on equity, so the profits that you're making are low. In this pandemic scenario, is actually, you're actually making a loss. Not unexpected, given that you may be paying out a lot in claims, and those claims will hit your P&L directly. And you can see that also in your insurance service ratio. So insurance service ratio, just to remind you, is that ratio that is akin to the combined ratio that Kezia would have mentioned before, where you're looking at your expenses over your revenue. In this case, before the pandemic or without the pandemic, you would have expected on your P&L to have more revenue than expenses and hence generate profit. Under the pandemic, the opposite is happening. So you can see how these are related, and you can see how they tell the same story. The capital is actually, I think, an interesting one, because with negative profits and something like a pandemic that's all over the news, I would have expected the capital to have a bigger impact. And why I say that is because if you were to just look at comprehensive equity, which is, akin to a measure of how much capital you have available in your company, it did drop. It dropped somewhat significantly from 65 to 58 and million. But your capital ratio didn't seem, it only took a hit of about 12%. It's not, doesn't seem that significant. And what that reflects is the fact that when you're looking at a capital ratio as opposed to just an equity measure, as opposed to just how much capital do I have in my business, you take into account also how much capital do I need for my business. So capital that I need for my business, if I have less people on the books because I'm selling less and more people are lapsing, is actually going to fall at the same time that my equity, my available capital fell. And that's actually what is driving that your capital ratio seems to have a smaller impact than the drop in your available capital.
So Christy, I have a question as well as I want to repeat a comment, so maybe you can dig in further. So what you just described is a scenario wherein profits and all the performance and growth indicators would be suffering, but capital would not be as impacted. Is that correct?
That's definitely correct, yes.
And the follow-up question to this is, maybe you can describe the capital ratio that you're using here and what leads to the distinction between the performance in capital versus in the P&L? Why would that be happening?
Sure. Okay, so your capital, the capital ratio we're using here is admittedly a simplified, capital ratio. But in essence, what it looks at is your available capital, which is very similar to your equity, albeit in different jurisdictions. You'll have different adjustments to that. But for the purposes of this conversation, you could think about it as something like your equity. And then on the denominator, we have a measure of required capital. Like I said, in this calculation, it's simplified, but generally across the board, your required capital would be basically you assessing what you need to hold for each of the risks that you have taken on. So your insurance risks, your risk of mortality, the risks that you have that people will lapse, the risks that you have because of the assets that you've chosen to invest in. These different risks, there are many different ways that you can calculate how much money do I need to hold back because of these risks, or how much money should I have to buffer against these risks and know that I will continue being solvent. So that is your required capital, which is at the bottom, and your available capital is essentially how much equity do I actually have. This capital ratio is basically just how much do I have over how much do I need, right? Generally, companies who have a capital ratio regime, they will have limits on how much they want this ratio to be able to drop. You would definitely want it to be above 100%, but in many cases, in every case that I've actually seen, or most cases actually, not every case, you would want it to be a little bit above that 100%. Right? In this case, it's very healthy. It's over 200%, but in some companies, that might be akin to what their internal target is. So that was your first question, Mark, was what is in my ratio? The second question was, why would it not be as impacted? That's the second question?
Right.
Okay, why would it not be as impacted is essentially what I described before, which is that both your required capital, now you have less risks because your portfolio has shrunk. You're selling less new business and you have higher policy lapses. So you have less people on your book to worry about. You have less money that you need to hold to account for those risks. And that is the reason why it would not be as significant a drop as you would see on your P&L, for example, which is just saying how much money did I lose in this period. Okay. So honestly, we got a good picture. And that's the point of going through the KPIs first. We got a good picture of what would happen in a pandemic, how would it affect your company, without even having to look at the financial statements directly. Now, I just wanted to take you through the actual numbers that would be behind this. It's a bit uglier to look at because it's a whole table full of numbers. Maybe not for the actuaries in the room, but for some people. But it's just to give you an idea of the numbers behind what we just looked at and to reinforce that you see from the KPIs that we have just gone through, you could already get a good idea of what happened here. So everything is in the red. This is the P&L, by the way. This is the income statement. Most things are in the red. And red here, red arrows, that is, means that it hurts the business, right? So in every case that you see red, it's because it's reducing your income. So your revenue dropped. This is basically driven by your new business. You have less CSM that you brought on, so you have less CSM that you're getting to recognize. Your claims and your expenses, these all go into your revenue, and what they represent is based on actuarial calculations. How much do I expect to pay out in claims? How much do I expect to pay out in expenses? Because now I have less people on my block, I have a lower expectation of how much I need to pay in claims, how much I need to pay in expenses. And that's what is really driving the insurance revenue. This is different in terms of interpretation as what you would see if in the older world where this would have just been premiums. Premiums would have dropped, but you see the reason why each of these drops is slightly different than what under IFRS 4 or and previous regimes. Similarly, you got a big hit on claims. This is what we all would expect. You have a pandemic, your claims increased. And this actually is the driving factor for the bottom line. What happened to your net income is the biggest impact. These dropped a little bit, you're selling less, but really you had to pay out a lot in claims. And these claims would not just be new business, they would probably be more your existing policies, so bigger in magnitude. I did mention previously that the investment income is lower. I mean, the interest rates are lower or lower than you would have seen in a business as usual case. And this impact is what happened because of that. Lower interest rates, you will earn a little bit less in investment income, but you'll have it offset a bit because now the discount rate that you're using, which as Mark would have mentioned earlier, is now tied to exactly what is in the market. The discount rate you're using would also be lower. And there is a opposing relationship between, the size of the interest that you have to pay and the interest rates. No, not opposing, related a relationship between them. So you have a lower interest rate, you pay less interest on your liabilities. Less interest on your liabilities is an uptick. So that's what happened here. Mark, you have a question? I see you went off mute.
Right. The question is, I guess, just for an explanation that these are simulated numbers. These aren't actually taken from any business line specifically, but simulated from experiences we would have seen in the pandemic. Is that correct?
Yes. Yes, it is, of course, simulated numbers. And even the magnitude, I would not get too deep into the weeds because different companies will experience different things based on what types of products they offer and how which would affect their liabilities. So yeah, so just to tie this back to the KPIs, we saw this picture already. Our ROE dropped, your income was lower, and your insurance service ratio went above 100%, which is that combined ratio metric. You see here, before we only paid 6 million, but we were earning 10. Now we're paying 11 million and we're only earning 9. And that's why it dipped up above that 100% mark.
And I have a follow-up question to this. So in this pandemic scenario, we could see where the actual claims shot up, but the expected claims did not. Could you explain why the expected claims and the actual claims would deviate?
Yes, definitely. So actual claims is pretty straightforward. That is exactly what you had to pay out in reality. Expected claims, however, I think I mentioned it earlier, it's a bit of an actuarial calculation. And what it means is that based on our assumption for what types of claims that we have, we calculate how many, what type of mortality rates we have. We calculate how many claims we expect. For something like a pandemic, which is relatively short term, you wouldn't necessarily change your expectations immediately to something extremely high because your expectations that you build into your revenue is supposed to be, what you expect over the life of the policies and not just next year.
So in
And
that,
that's yeah.
in that instance, the expected claims is a lagging indicator compared to the actual.
It is. Now, I will say though, let's say because of the pandemic, there was, it was a very long COVID, and you started to see that maybe this is a more permanent change in my mortality rates. We would absolutely factor that into the expectations, and the revenue or the expected claims up here would start to increase over time. Right, so we took a look at the P&L, which really was driven by the profit metrics, which really what tells the same story as the profitability KPIs we had. And we'll switch now to the balance sheet, your financial position, your assets, your liabilities, your equities. And these are actually the driving factors behind what we saw on the capital KPI side. So you would have seen our equity, it went down. I think we mentioned that before. And we would have had a discussion about your required capital. So how much capital do you think you need to hold to cover the risks that you have on your company? And again, as we said before, it went down. It's exactly what we expected, and exactly the reason why the capital ratio was a bit offset by this reduction in required capital, and therefore was not as significant as the drop in equity taken by itself. Other things you'll notice from this is the change in CSM. On your balance sheet, your CSM forms part of your liabilities, right? You have your present value of future cash flows, the risk adjustment, and the CSM. This is actually your risk adjustment, and your CSM is, as Kezia would have mentioned when she was going through the KPIs, pieces, things that are sitting on your balance sheet that over time will get released into your P&L. But in this case, you see, we did not grow because of the pandemic, and your CSM fell. Okay, so that's yeah.
Question, sorry if I can interrupt you here. The present value of future cash flows, which is the BEL. The question is, in this instance, we see the BEL going up. Maybe you can explain now the lagging expectation on this for this.
The lagging expectation. Okay, so your BEL typically goes up when you think you have more risk that you're on the hook for, right? So there is an element of shoring up or putting more on what we would have called in the past in your reserve, or in your amount of money you're holding for what you think will happen in the future, because we know things are going a little bit bad. The other aspect of this is that you will have, interest rate movements. Right. That your BEL, it says present value, because it's not just, okay, I expect to pay out 10 million more in claims in the future. It also takes into account, what is the
discount rate.
The discount rate that I'm using. So your present value of cash flows, like you said, it's based fully on our expectations, but it could increase because we are expecting that things will eventually get a little bit worse, and we want to take that into account. There was one other point I wanted to mention actually before I moved on, that I'm glad Mark stopped me because I almost forgot, which is that, so based on what we saw in the financial statements, we saw the profitability, what we gained from the profitability KPIs. We saw that already told us the story that income reduced. We saw from what we see in the balance sheet that this tells the story of what happened to equity, and what happened to our capital ratio, which we saw from those capital KPIs. When it comes to the growth KPIs, the only one we actually see from just looking at these financial statements is the change in CSM, right? But if I were to flip back to the growth KPIs, what we actually have available to us is much more than just the change in CSM. We have these three at the bottom that actually just carve out the experience of the new business. And previously, or actually, if you just look on the financial statements by themselves, you're not actually even going to see any of these types of metrics. IFRS 17, and as Mark would have mentioned when he spoke in the beginning about CSM, loss components, and grouping of contracts, forces us to look at our profitable contracts with our non-profitable contracts forces us to treat them differently, but also therefore gives us more data. It allows us to now look at, okay, our profit-making business, our new business, the profit we're getting from the new business separate from the losses, and it makes available to us many more KPIs to really deep dive into what is driving our growth, what is driving our profit, and what's driving our performance. So just to make that point that we just went through the financial statements, which is supposed to be the be all and end all. And we just, because of IFRS 17 accounting, we have these metrics that are available to us that, you know, give us a better idea of what's going on in the company. Okay, so that's it for the pandemic. I'm moving on to scene two. Scene two is oil discovery. So very different from the pandemic. Now we have an economic boom, right? People are making lots of investments. There is a lot of economic activity happening. People have more money. We're getting more sales in the insurance, but with that comes higher inflation and higher interest rates in the market. So the market is very hot. The protagonist is again the traditional life insurance company, but it's a different year, different time, right? And you see from the growth KPIs, something very much the opposite of what we saw in the pandemic scenario, which is that you're growing. It goes without saying. You have more new business, there's more economic activity, you're going to put on more CSM. Your sustainability index is high and even higher. Your new business contribution, now you're selling more, your CSM that you're putting on from your new business is a bigger percentage of the CSM that you have. And the value of your new business is also increasing, mostly because you're selling more, to be honest. Very much as expected. Profitability, again, tells the same story. Your ROE is increasing. You have, well, versus your business as usual. Your insurance service ratio, which is your expenses over your revenue, this one looks a little funny. Why is this increasing? I thought this was supposed to be bad things. This is how much expenses I'm paying out versus my revenue. And so this one initially could seem a little counterintuitive, but if you remember what happens when the market is hot, you have high inflation. So along with all this nice new business that you're putting on, you're going to have higher expenses, right? So just from looking at these 1, 2, 3, 4, 5, 6 numbers, we already could have a good idea of what we know is going to happen on the P&L. We know that they're going to have new business, so you're going to get some more revenue. We know that your expenses are going to be higher. Just from looking at this KPI, we know that the expenses are going to be less than the revenue, but higher than what we would have under a business as usual context. So you see how powerful just having a few KPIs that you're tracking in terms of telling you what's going on your financial statements. Interestingly, and this is why this scenario was called an antagonist, is because in this world of everything looking so nice and rosy and beautiful, good times ahead, high bonuses for everybody's future, you have the capital KPIs. And despite the fact that this seems to be a much more favorable scenario than the pandemic, the drop in your capital ratio is actually 25% versus the 12% we would have seen on the pandemic scenario. And the reason that this is because of what we were explaining earlier about required capital. When you look at what happens with a capital ratio, it's not just, oh, how much more money did I make? How much more equity do I have? It is, how much more risk did I take on? And in this scenario, with all this new business you're putting on, you're taking on more risk. It's not a threat to your company, but it's something you need to be aware of, in that if you grow too fast, you actually need to make sure that you are monitoring this metric to make sure that you're not taking on so much risk that it's causing your available capital to, be a smaller percentage and get too small. Okay. So that is the KPIs that we went through for the oil discovery. Again, profitability and growth, honestly, they seem a bit instinctive. As soon as you know that things are going good, they kind of get better. You're growing more and you're more profitable. Capital, a little bit more complicated because now you have to consider, okay, what I have and what did I take on? Looking just at comprehensive equity, it tells a good story, but that's the importance of why you need a capital ratio.
So if I were to now extrapolate that comment, I'm in a room with regulators. Are you therefore suggesting that as businesses grow exponentially, that capital considerations become more important because they could lead to strains?
Yeah, absolutely. That's what I'm suggesting is that you know, something that is just a good picture still needs to be monitored, and just looking at the financial statements with just what I have, my equity, might not always suffice, because this is going to tell a really nice picture once you are growing. Okay. So, right, just to give you an idea of the P&L in case you're curious, honestly, what we went through and the KPIs kind of told us a lot of what we need to know, but you can get a deeper dive into what is causing it. Again, the ROE went up because your profit went up. The insurance service ratio went up, as I mentioned, because you have higher inflation that's causing higher expenses. And you'll notice here that there is something that the IFRS 17 P&L has done, that it makes it easy for you to see how you're performing or break down, you know, exactly what's happening with your claims and your expenses, right? Because there are expected claims and expected expenses. So you see how much the actuaries are releasing based on what they thought would happen. And it's compared directly on another line on the P&L, which is actual claims and actual expenses. So in this case, you'll notice, because this is, of course, best case scenario, we got everything right as actuaries, and your expected claims is equal to your actual claims under both scenarios, right? There's nothing in this scenario that would make oil discovery that would increase your claims, at least in our assumption. However, if you look at expected expenses to actual expenses under the business as usual case, again, we got it right. But now with this unexpected event happening, our actual expenses actually now exceed our expected expenses. The expected expenses did increase because we have more new business, so we do expect to have more people to pay for, but not as much as the actual expenses, because the inflation, the expense inflation that's happening in the market, that is a lagged indicator that will eventually make itself in our expectations, especially if it is more pervasive. And just quickly, just to go through the financial position, is nothing really that important to tell, except that your equity did go up, but notice your required capital went up by more. And that's exactly what we were alluding to in the capital ratio, that equity by itself doesn't tell you the full picture. Okay, we are flying through. And we have just one more scenario. And this time we're going to give our other protagonists a little bit of shine. So now we're switching to, instead of a traditional life insurance company, which is just selling, you know, what you consider your basic life insurance product, you know, a long-term life insurance product, to a company that is more savings oriented. What that means is that the products that they offer have an insurance component where, you know, you have coverage in case you die or in case something bad happens, but it also has a savings component, which means that we're also taking on deposits and investing it for policyholders. Right. One thing you will notice about this protagonist versus the other one is that the numbers seem bigger and they seem to swing wider. And it's exactly because of that reason, you know. So it's because once you have a savings component as well as the insurance component, things become more volatile. You now have to consider that people are surrendering and withdrawing large amounts that might have nothing to really do with your insurance risk, and that can make the numbers go up and down a lot more. So in this situation, there's a loss of confidence. There's a company, something happened, maybe not even their fault, but there's a loss of confidence in this company. And because the company's reputation has taken a hit, people are trying to get their money out, which is honestly more significant in a savings-oriented situation, because you could go in and you could take out with large withdrawals of your money. You could surrender your policy and get all your savings components back. Or you can have, and in addition, well, you can have very low new business sales, which honestly would have occurred whether it's a traditional or a savings-oriented life insurance. Starting with the growth KPIs, this is what I mentioned before in terms of the numbers looking much bigger, because there's a run on the bank, and I call it the bank, but it really, I think you could use this term to mean any financial institution, but it's a run on the insurance company, and your CSM has taken a massive hit, largely because of the surrenders and withdrawals that are coming out. Your sustainability index dipped under 100%. The new business contribution, strangely enough, is a larger percentage of your overall CSM. And the reason for this is because it's a ratio. So your new business dropped, yes, but where on a savings-oriented company, a lot of the money and deposits is in those people who have been with you for a few years and keep putting money in. So when they come and they withdraw their money, is not necessarily the people that you just sold to. And so that dip in the CSM is really coming from both existing and new business, and in many cases, more existing than the new business. And so that's the reason why this ratio would get larger, because your new CSM, yes, it's smaller, but your total CSM is even smaller. And lastly, a value of new business, similar to what we would expect. Moving to the profitability and capital KPIs, profitability tells the intuitive story as it did in all the other situations. Numbers look a lot bigger. They're changing a lot more than business as usual, consistent with what we said about savings-oriented companies. And capital, being the odd man out again, is moving in a way that might need a little bit more explanation. But by now, I think we kind of got the picture. We understand why capital might move in a different way. In this case, strangely enough, your capital ratio actually increases, right? It's a run on the bank, but your capital ratio is increasing. This is really because of that savings component and the fact that, people are surrendering their policies and taking all their money out. It's having a large impact. And this is not necessarily, this is a situation. It's not necessarily that every time there's a run on a bank, your capital ratio is going to increase. But there are situations where, at least initially, once that money starts coming out, your capital ratio increases because more money is coming out than your equity is falling. And that could be a reason why. Notice though, this is capital, not necessarily liquidity. Liquidity might be a separate problem that would hit way before you have any capital problems. You'll have a liquidity issue. The reason why you mightn't see liquidity exactly in this presentation, because liquidity, unlike the rest of the KPIs that we really want to be focused on, what is hitting my income statement, liquidity has to do with cash. How much cash is in, how much cash I have, how much cash do I need to pay? And those types of metrics really are the same under IFRS 17 as they were under IFRS 4. It's not about your insurance accounting, it's about the actual money that's sitting in your bank accounts. Right, so that's why it's not mentioned here, but there would still definitely be a liquidity strain, as you would expect.
So the assumption here, this is a question, the assumption here would be that the savings component forms a part of the liability, and as a result of the run on the bank, the liability, which is the denominator you explained, would lead to the increase in capital, correct?
Correct. That's an important point that you bring up, Mark, because in many cases, the companies will sell UL products where there's a segregation of that savings component to what's on your business, your book of business. In that situation, it would work more similar to the way that a traditional life would work, because you have your insurance risk is what's really driving what's happening on your P&L and your balance sheet, whereas the savings component is kind of, separated. Yeah, but even under those situations, you might even be able to have, under IFRS 17, you might even be able to separate those components completely and not even have to worry about them in this framework. In this case, to make it interesting and to see what will happen under the situation that you just have all those deposits and you're managing them along with your normal assets and as part of your general assets and business, and measuring them under the standard IFRS 17 GMM model, this is what you would expect to happen.
Thank you.
Okay. Right. So yeah, so here we see a bit of up and downs. It's a little different from the last ones, which were more downs and then more ups, but the numbers also are bigger. This part, I just wanted to go through a little bit because it introduces, if for the first time we're seeing this drop in CSM and this line being filled out. You would notice in the, well, you might remember because it's a lot of numbers, but in the previous two, we didn't really have too many big swings in this line called losses and reversal of losses on onerous contracts. So I'll explain a little bit, try to explain briefly without being too confusing about what's happening on this P&L. The biggest thing that's impacting would the large negative numbers you're seeing are those surrenders and withdrawals. So your CSM, like you had seen in your growth KPIs, they dropped a lot. But in some cases, and for some groups of business, there would be situations where your CSM maybe dropped so much that it went into a loss-making, CSM is essentially negative, but there's no such thing as a negative CSM. What that then becomes is a loss component. Under IFRS 17, I think we would have mentioned early on in the presentation that when you have, because we have this disaggregation of, profitable and non-profitable business, the reason why the standard forces you to treat them differently is because you also, to separate them is because you also need to treat them differently. Remember, CSM is your future profits, and what would happen is you make that future profit and it will trickle into your income. And that's what you're seeing on the CSM recognized. This is the trickle off of what you sold this year, what you have from years before, the people who did not surrender. It went down, but here you have the losses and reversal of losses on onerous contract. In this case, it's not a reversal, it is a loss. That's why it's negative. And what it represents is those groups of policies that because of the run on the bank became, the CSM got eaten so much that it went into loss making. And under IFRS 17, you don't get to do what you did with the future profit. You don't get to then take that loss and say, okay, I'll take the loss and trickle it into my income statement over time. No, you have to take that entire loss immediately. And that's why this number looks so big and ugly on your P&L. And that's what happens if you have this dreaded loss component or onerous contracts starting to develop in your business. Yeah, so that's basically it in terms of the run on the bank, because I think we have exhausted the financial position. We know what's happening. The only thing to illustrate here is what we already saw on the capital side, which is that your equity fell, but your required capital fell by even more. And so counterintuitively, your capital ratio actually increased in this scenario.
Right.
Yeah, okay. I will just summarize and then we could, I don't know if we have time and then we
Let's try to
can,
squeeze
no,
in
we
one
don't
or
have
two.
time.
I'll
Sorry,
squeeze in
okay,
one or
we'll
two.
try to squeeze in one or two. Okay, well, maybe, okay, well, let me just conclude. So to conclude, to takeaways, IFRS 17 has given us many more data points. We've been forced to go through this process where we have to disaggregate profitable and non-profitable and track things differently. But what it's done is it's forced us to do that exactly, which gives us more information that we can then track, that we can then learn from. The important thing to do is to group these KPIs based on their intent, growth, profitability, capital, and really choose the ones that you think best satisfy the needs of your business, the types of products that you have, and the type of market that you're in. And to keep in mind that this is very new. We've only been under IFRS 17 for a year or two, so things will be changing. Keep your mind open. We might come up with new KPIs. You might come up with new KPIs that you think better reflect your situation. And yeah, it's an opportunity to really try to enhance the way we monitor our business and maybe even get better at forecasting in the future.
So 2 quick questions. So forgive me if I'm not able to go through all, and maybe I can poison some comments here. 2 quick one was on the KPI. Several KPIs are listed as amounts, and I guess that would be important for insurance companies or opposite to record them. But for the Roman regulators, I believe what we might see is a situation where you need to base these KPIs. There are several KPIs which are, I guess, directionally indicative, but you could base these KPIs based on previous performances to see how they have changed from peer to peer. That would be one comment. And then the second one, we were asked to comment on, would it be a good idea, maybe I'm paraphrasing here, a good idea in a capital strain to encourage policyholders to surrender. This is not an official actual opinion or comment, but I wouldn't push that kamikaze button per se. I think there are far more useful and better alternatives to improve a capital position than to encourage policyholders to lapse. However, in the event that were to happen, I think Christy clearly went through how that would not be as unfavorable on the capital side. But it's not. I would not recommend that you go to your policyholders to encourage them to lapse in the event that there's a capital strain. I don't know if Kezia or Christy, you'd like to comment on either of those two.
Yeah, no, just to say 2 things. Yeah, once you're lapsing them, but you're also gonna have to pay them, and so then your equity is gonna take a hit also. And secondly, IFRS 17 has taken away some of the levers that we would have had in the past to do anything that significantly impacts your profit and your position, because it forces you to do things such as amortization that trickles good and bad things. Well, trickles good things into your statements. So mightn't be as effective as some of the creative strategies that might have been implemented in the past.
Okay, great. Thank you so much, guys. Thanks to CARE. The actuarial community is committed to ensuring that we are present and to provide you with the support. There was a question again from CARE. I think we will handle that separately in probably a written message. I think I like the orientation of the question, which relates to how can these 2 associations continue to support each other and to make sure that the KPIs that are disseminated across the region are apposite and relevant to the insurance products and will capture what we want. Many thanks to Raymond and your team. Elizabeth, over to you.
Oh, so it's over to me actually, Mark. Thank you. The Caribbean Association of Insurance Regulators would like to thank the Caribbean Actuarial Association for facilitating and partnering with us in this webinar. It has been very insightful. We know that we're strapped for time, so I'm going to keep it short. But I'd like to thank the ladies and the gentlemen, Christy, Kezia, and Mark. And I'd also like to thank the CARE Secretariat and the planning teams. And thank you for tolerating all the emails, calls, and logistic issues that we overcame to make this a success. And I think it was a success. This has been very insightful. We appreciate the time and the care that you have, excuse the pun, that you have taken to give us this this presentation. And we appreciate further collaboration in the future. We really appreciate the team and our guests, our participants. It seems like we had over 150 participants. So we thank you all for taking the time out to listen, to absorb, to be engaged and ask questions of the team. And we thank you for all the insightful answers. Take care all.
Thank you.